Here. 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 We have a quorum. We'll now do our swearing in. Captain Newcomb, if you could join Ms. Krantz at the podium. They can see you.
I, Matt Newcomb,
Do solemnly swear or affirm
do solemnly swear or affirm
that I will support, protect, and defend the
that I will support, protect, and defend the Constitution
and government of the United States
and government of the United States
and of the state of Florida,
and of the state of Florida,
and the charter and ordinances of the city of Palatka,
and the charter and ordinances of the city of Palatka,
that I am duly qualified to hold office
that I'm duly qualified to hold office
under the Constitution of the state,
under the Constitution of the state,
and that I will well and faithfully
and that I will well and faithfully
perform the duties
of police officers pension board member
on which I'm about to enter.
on which I'm about to enter.
So help me God.
So help me God.
Welcome aboard, Captain.
Thank you. Did you need me to sign this?
Welcome aboard, Captain. We now have approval of minutes. Does everyone have opportunities to review the minutes? If so, I entertain a motion at this time.
Some of we approve.
There's a motion on the floor to approve the minutes for the September 21st meeting.
Second.
Second. All in favor, say aye.
Aye.
Opposed, motion carries unanimously. Moving on to the experience study. Patrick Dolan, Foster.
Hey guys, can you hear me okay?
We hear you. Yes, sir.
So basically, I proposed an experience study a couple meetings ago where, because you're supposed to do one every 5 years and it's been 5 years. And you look at the assumptions, your experience relative to our assumptions, and then we make recommended changes to the assumptions. And then we show you guys the impact of those recommended changes. And you guys had tabled it because the city was doing that salary survey. And I believe, it's nearing complete if it's not complete already. So I think the board could approve the experience study now.
Any questions from the board? And just for a point of information, can you go ahead and give the change in the assumption?
Well, we're going to show you scenarios of different changes in the investment return assumption, if that's what you mean.
Correct.
We'll show you your assumption, and then we might show you 7.5%, 7%, 6.8. We'll show you a couple of different scenarios for you guys to look at.
Any additional questions or comments? Seeing none.
So now then I can bring it with me to the March meeting and present it alongside the valuation report.
What did your other boards do?
Well, the auditors recommended, so almost all my boards are doing one, every 5 years. It's not an exact, it doesn't have to be exactly, but let me just look and see when the last time you did it. And the general board already did their experience study, and the fire board didn't have a full board today, so they tabled it again until the March meeting. Give me 1 second to find that answer. Yeah, September 19th, 2016 is the last time we did one. So if we did it at the March meeting, that's about 5.5 years.
You do a gauge annually as well, right?
Yeah, I mean, we're always looking at the assumptions and we talk about them when I present the valuation report. But this is a formalized study to look at your experience over a 10-year period is what we normally use. And we look at like salary increases. What have they actually been compared to our assumptions? So maybe we should tweak that assumption going forward, that type of thing.
Any other questions? Is there any harm in pushing this out and not pulling the trigger now?
Yeah, I mean, you could decide at the March meeting. And then I would probably come back, or present it to you next summer.
At this point, you've heard the recommendation from Foster and Foster. Is there a motion or any other conversation?
So additional conversation, Greg Cummings, what portion of the data or the outcome of this report, once we make a selection based on the scenarios, goes into our annual report, if any?
Well, so if you guys table it till the next meeting, then, in March, I'll present the October 1, 2021 valuation report. And that'll have using all the current assumptions. And then if you guys do an experience study next summer, then we would make those changes with the 10/1/2022 valuation report. So it wouldn't really affect the city for another 2 to 3 years.
Thank you.
What is the actual cost of the evaluation?
I would honor the $7,500 is what I quoted you the last time. And like I said, it's a once every 5-year, cost.
What's the advantage of doing the evaluation now and tabling it until March? What do we accomplish?
Well, I'm gonna be at your March meeting, and then we could go over the experience study in person, rather than either you'll have to pay for me to make a special trip up there next summer, or we could do it by Zoom or something. So that's really the only real advantage, I guess, because either way, you're not going to make the changes with the 10/1/2021 report. You're going to make them with the following year's report. So it's really just, that's the main issue of why you would want to approve it now rather than wait. But either way is fine with me.
Okay, I'll entertain a motion. If there's no other questions.
And I know that this is further discussion. I know this is a probably a non-compliance issue because it's a recommendation that we do it every 5 years. Do we run into any compliance issues by tabling this until March?
No, I mean, if you wait 8 or 9 years, you're gonna have a problem, but waiting another 6 months isn't gonna cause any huge alarm.
Okay.
It's like buying an extended warranty when you got 3 years left on your factory warranty.
Don't talk about those. I hate those phone calls.
Okay. there a motion?
Make a motion that we table this decision until March meeting.
So motion on the floor to table until March,
A second.
second by Mass. Is there any further discussion? All in favor, say aye.
Aye.
Opposed, motion carries unanimously. Thank you. Next up, Sawgrass.
Oh, no problem. You guys don't need me anymore for the meeting, do you?
No, sir, you're good.
All right,
Unless
well,
someone
happy
else-
holidays, everybody.
Yes, sir. Same to you.
Okay, bye.
Well, good afternoon, everybody. Happy holidays. My name is Greg Gosh. I'm Client Services Manager for Sawgrass Asset Management. We are your fixed income / bond manager, and welcome to the board, Mr. Newcomb. It's good to see you in person finally. How are you? Mr. Norwood. So it's good to be here. We're out of Jacksonville Beach, Florida, just to give you a quick rundown on Sawgrass. We're actually moving to Ponte Vedra in the Sawgrass Village. So it's kind of fitting. Sawgrass will be in Sawgrass Village. They didn't name it after us. We named ourselves after them. But just getting started here on page 9, you can see your performance from when the time you hired us. But then if you turn to page 10, you can see your quarter to date as of 9/30, when you moved over to the collective investment trust, the CIT, from a separately managed product that we had you in before. And the advantages for you were a couple of fold. Number one, your fee went down. Number two, your liquidity and ability to raise cash is quicker through the CIT. We've actually added, I want to say between 8 and 10 other clients in the CIT on the pension side since you guys made the switch as well. So I want to thank you for having your trust in us to do that and help us get this thing going. But you can also notice on page 10, the return. Dwayne's going to get up here and show you these wonderful numbers that you had for both fiscal year and year to date. Actually, those will be fiscal year because they'll be 9/30. Somewhere in the neighborhood, I want to say 28%. Well, fixed income last quarter returned you 6 basis points. And we're going to get into why, everyone understands what's going on here in the world, but we're going to get into why the yields are so low and have been, and the returns have been so low here in the last 10 years pretty consistently, with a couple of positive hiccups along the way. So for the 1 year, you have a negative return. Your fiscal year is actually negative with fixed income. And you can see we underperformed the index. And what happened, what we've done, because these are the types of scenarios where we usually outperform. The way the market's going is the market is priced to have 3 interest rate hikes by the Fed next year, from what we're seeing. It's been very aggressive. We shortened duration and shortened a lot of our bonds because we felt that with the returns that we're getting, it's better to have to be shorter, especially with the way the economy is going with inflation, than long. With better yielding bonds moving forward, it's better to be short than it is to be long. We're trying to be conservative. Well, it was the reverse here in the last quarter or two, or actually 2 quarters. So right now, our performance as of 6/30 that I showed you on page 10 includes 1 day out of the market. We also paid you a credit for that. There was some money that we felt that you would have made had you been in the market. So we refunded you that money from Sawgrass. We thought that was the right thing to do. But the year is not about duration, but yield curve positioning. The 10-year treasury is up 90 basis points year to date, while the 30-year treasury is only up 15 basis points. Again, it's a very aggressive Fed in the way the market is priced right now. We think high rates are soon going to cause a possible short-term recession next year. And we're going to learn more tomorrow when the Fed has their meeting, and hopefully we don't just get telegraphed information. We get more of specifics as to what the plan is. But there's 2 things that are kind of making it difficult for the Federal Reserve to take away the stimulus or slow it down at the speed that we think they want to, is you've got this Omicron variant going on right now, and you have inflation at levels we haven't seen since, Jimmy Carter, Ronald Reagan were coming into office. We're going back 40 years now, which I can still remember when that happened. So I feel very old even saying that. But we have those two issues going on right now, and we've gotten this far in the economy, especially the last 2 years, year and a half, with a lot of stimulus. Well, we had a lot of stimulus in 08, and we didn't want to get rid of all of it. And then 10 years later, 2018, we start raising rates and the stock market reacts in a negative way. So we start slowing that down. Well, then stock market comes back up, economy bounces back with it, and we have COVID come out. So we had more stimulus through this COVID period in the last 18 months than we had in the entire Y2K, the 9/11 issues, the Afghanistan issues, and Iraq issues, when we were still stimulating the economy under Bush 2. And then with, of course, the financial crisis. Those combined are still less than half of the stimulus that the Federal Reserve and the Treasury have put into the economy just here in the last 18 months. So it's like going through all the world wars and everything the country's gone through, and the amount of expenses that the country has used, and all those periods combined. And we put more on our credit card in the last 18 months than we did in our entire history combined, pretty much. So that, we think, is going to cause some ripples when things start to unwind, which they naturally should. So the current hot topic right now is the new Fed policy pivot. They're removing the word transitory from the inflation right now, which means they plan on being more aggressive with the balance sheet taper, accelerate the wind of additional asset purposes, and look at the end of Q1 in 2022. We don't have an indication yet on the changes to the Fed's take on future rate hikes. But like I said before, we think the market is now pricing 3 rate hikes next year and 4 in 2023. So we've been at near zero here for quite some time. So we're going to remain short with your portfolio on duration, and we expect higher rates. And the Fed will prove to be, we think the Fed's going to be a little bit more patient than what the market's saying right now. We don't think the hikes are going to come as quickly, but the market is telling us right now 3 next year and 4 in 2023. And I know a lot of us are just trying to forecast the next quarter or 6 months, but the bond managers, we're looking at years down the road and how that impacts even the short-term numbers. So I know that was a lot of air that I just took out of the room, but this is where we sit. This is how we're forecasting the future. And it's kind of where we are.
Any questions?
Any questions?
No questions.
Okay. Thank you very much.
You've heard the report from Sawgrass. I'll entertain a motion to approve the report.
That
Move to approve
was-
the report.
No, it's 6:30 going into 9:30. The first day of that quarter is the day out of the market.
There's a motion to approve the Sawgrass report. There's a second on the floor from Captain Newcomb. All in favor, say aye.
Aye.
Opposed, motion carries unanimously. Thank you. Appreciate it, Greg. Thank you. Next up, Dwayne with Capital City.
First, I want to introduce reports from Spring Hill. I'd also like to say for the newer members, nice to meet you. Been a couple of years since I've been Capital City. Recent changes at Capital City. We hired 3 new trust administrators, and we acquired a strategic otherwise, activities, business activities. Having said that, have a report in front of you. We go to the first page inside on tab 1 is the policy review, which has numbers on it. This is up on the screen. So I'd like to review with you the plan stance versus your investment policy. And so currently we're overweight in large U.S. companies, and we've been overweight for a while, and at the expense of being underweight international. Long story short, business conditions in the U.S. are better than Europe and China. And there's a lot of reasons for that. Growth, strong dollar, great companies here and there. Also, to be overweight in large U.S. companies, I have to be underweight in something like chose convertible bonds. Convertible bonds are a little bit more difficult to get than Walmart. Not that convertible bonds are bad. However, they are not total equity, they have equity outcome, so they're hybrid. So I chose to underweight convertibles, and that may not always be the case. During the third quarter, I did move some money to Sawgrass because your equity allocation is getting near its policy limit of 70%. And I also moved a little bit of money to the infrastructure program at SCI, which is not housed in Temple City. So those are the changes I made. As equity approaches 68, 69%, I tend to trim it back and hold cash for a couple of weeks until I can decide what I'll do with it. And it's usually moving it to Sawgrass because cash, as you know, earns zero. That's the Federal Reserve. So, any questions on the?
I have a question, Mr. Chairman, if I may. You mentioned that the custody of the Cohen and Steers is at SCI, so there's no, you're not charging a custody fee for that? Okay, then with the CIT, the Collective Investment Trust, that's also custody with a different bank. Do you carry that as a security that where you charge your?
We do carry that as a security.
Okay, thank you.
I guess my question would be, does the policy,
So just to let you know, I believe that fee is 10 basis points on that CIT.
does our investment policy allow us to be 6.7% overweight in the large cap equities?
That's a good question. Does it specifically give me limitations? But I don't go too far. I think where it is now is as far as I'm going to go.
Okay. Burgess, does that require an approval of the board to?
Given the fact that there are no ranges, some policies have ranges. But we have felt comfortable over the years that we didn't need ranges here, as long as he didn't go too far over and we understood why he was doing it, we haven't made an issue about it.
How far is too far?
You know, that's a good question. You don't know what too far is unless something goes wrong. So that's a good point.
Let me say, that the trust company, which have, say, 600 clients, their ranges are plus or minus 10. I would never go more than 10%. Because that's our internal policy.
I guess my question would be, should that be reflected in our policy as well? If we're going to say 10% is too, over 10% would be too far.
We could revise the policy and put an upper limit. And it might be, that upper limit might be somewhere around 25%, something like that. We can certainly do that.
Well,
I'm happy to do it.
You know, I just want to make sure that when we do, when we do set policies, that we stay within, and if the policy doesn't address it, and we feel like it needs address, in order to make sure that we still give them the room to make whatever adjustments they need to make according to the market. but by the same token, stay within policy guidelines as well. But I guess if 10%, if over 10% is the kind of the over guideline for the investment company, I think that this portfolio should have some type of policy around that as well.
Well, you've raised a very valid point, and I'm more than happy to present at the March meeting, March 15th meeting, a revision in the policy which addresses the upper limitation, basically upper end and the whole range.
Mhm.
And it's a good idea, and I can certainly do that for you. You're welcome.
So, other questions on account performance? This is not 30, so this is the third quarter investment report, and not great numbers for the third quarter, -0.7, equities -0.9, bonds 0.88, real estate -0.28. July and August were decent months. September, the market got a little expensive and some bad news came into the market, like inflation, slowing economy, what's the Fed going to do? And investors use that as an excuse to sell off equities. And I think it was needed. The market was letting off steam. So September for equities was about -4 or 5. That was the last month of the fiscal year. Nevertheless, if you look at the year-to-date and latest one-year number, you'll see, excuse me, if you look at the latest one-year number, it's 29.6. That ending 9/30, the equity side, not sawgrass, but the equity side returned 29.6. Total. Then the stocks returned 32.2. The bonds, which are high yield, and convertibles returned 7.6. But convertibles are mixed in there. It should be an equity and cash. And real estate 32.2. So for your plan equity side, it was a terrific number, and you probably won't see a number like this for some time because it was driven by the Federal Reserve stimulating the economy, and when you stimulate the economy, you stimulate the stock market. Sort of hand in hand. So when rates went down to 0 or less than 1%, the ability to get return will become inflation, except for equity. Maybe real estate and commodities, which are so good numbers. This is going to help the long-term averages. And next year, growth is forecasted to slow down as the Federal Reserve quits propping up the economy. So, however, inflation running 6.5% and your goal of 7.5% return, equities is the asset class of choice. You still need bonds as a prudent fiduciary to balance the volatility in equities and serve as a cushion when equities go up. So in September, when equities fell, bonds went up. That's what we want. We don't mind if we fall a little bit. There's no questions. The next page is through October. The good news, and what came out in the month of October. You look at the year-to-date number. This is the this is the this is ending December. This is ending December. Calendar year-to-date, which is 17.3%. Through the end of October, the equity side returned 17.3. So that reflects the great October where equities returned 5%, which was the best month in the year 2021. October gained back everything September lost. And then November's been sort of flat and December's been decent. So we're off to a decent start for the next fiscal year. We'll cover that in the next. But there's no questions on the terms. We can go on to the asset allocation portion. Where equities are now 57%, that includes convertible bonds, which we deem as equities. If you add the equity at 57% plus the real estate at 5% and the infrastructure, which is about 5%, you're up at about 67%, which is about as high as I want it to go. If it gets any higher, I'll be trimming back equities. So we have a moderate growth portfolio. It's not aggressive, but it's not balanced either. But it's designed to get you to 7.5%. It's chosen for that reason. The rest of the report is the mutual fund managers that we use. And you'll see the Sawgrass Collective Investment Trust in there as well on the next page. It says fixed income holdings. Here we go. And at the bottom, our real estate index fund, which is 3% and is a great substitute or diversifier for bonds. However, because real estate can be volatile, we don't hold a whole lot of it. But it's usually about 5% or less. So one other administrative item I want to address is our bank auditors require us to re-sign investment policies every 3 years. Yours is up. Re-sign if you make a motion to reaffirm the policy, the minutes will serve as that approval for our bank audit.
Well, we're addressing the policy in March. So I'm in the midst of revising it right now. It's possible we could get this done today. I could read into the minutes what the changes are and then have the finished copy provided to Jill today. Or we can do all this in March. There's no urgency. Can your auditors wait 3 months? Wait until March.
Bring it back in March. Anything else? Seeing you've heard the capital city report. Is there a motion?
Make a motion that the capital city company report be accepted.
There's a motion. There's a motion on the floor and there's a second.
Second.
Let's see. All in favor, say aye.
Aye.
Opposed? Motion carries unanimously. Thank you. And Merry Christmas to both of you. Next up, BCA, Burgess Chambers.
Good afternoon, ladies and gentlemen. Pleasure to be here. Just walking around Palatka today, maybe it's my imagination, but there's a sense of prosperity in the air. Nicer cars, saw a fancy Porsche, saw a couple Mercedes. Something's happening in this town. Got a good mayor. Mayor's doing stuff. I'd like to take you please to page 11 and look up at the top right-hand corner. I'm gonna tease Patrick about this in March because when he presents the experience study, he's going to talk about salary increases and turnover and all that kind of stuff. Because all these little pieces, as you know, moved everything around. Now, for most of the last 10 years, the budgeted return assumption was 8. And then it was dialed down to 7.5 gradually at where it is today. So I'm gonna submit this to him. If the return assumption has been somewhere between 8 and 7.5 over the last 10 years, and we've actually beaten that, are we going to increase the assumed rate of return? The answer is going to be no. This is a very inexact science, trying to figure out what's going to happen. Clearly, we've done much better. Cap cities and the board have done a much better job in achieving, if not beating, the assumed rate of return than was forecast and budgeted. I'm prepared to recommend next year that we stay at 7.5 for at least another year. There's no reason to jump to 6 to 7. There's going to be pressure from the actuary to go to 7 or 6.8, where the FRS is at 6.8 now. I don't think you need to do that. We have the evidence here to support staying at 7.5. So that's, I'm just telling you now, that's where I'm inclined to be next year. I think Greg did a good job, and so did Dwayne, who's already left, in giving you a sense of how inflation is out there. We're talking about it now. It's already influencing people's budgets and what they buy and how they spend money. And I'm not an economist, so I'm not going to tell you where inflation is going to be next year or the year after, but the Federal Reserve is certainly going to begin slowing down its purchases of bonds and mortgages next year. And that's going to affect the mortgage market. It's going to raise mortgage rates. It will probably begin to tap down the housing rush because it'll cost more to finance. So that's that. But those measures to slow things down, this is a big ship. This is like a super tanker. Those measures don't instantaneously slow the economy down. There's a 12 to 18 month delay. So it'll be well into 23 before you see any of those slowing measures begin to move the economy downwards. There's a little piece on page 1 about the supply chain quandary, and I think you all have a pretty good sense of by now how that started and how that's going to resolve itself. On page 4 are the summary remarks. The model here is a 65% equity model. I should point out that the 35% that's invested in non-equities is invested in high quality bonds and then very low quality bonds. So we differentiate. We have a high yield that's low quality, and 90% of the bonds are in high quality. The purpose of the bonds is to pay benefits. That's it. And some people think the bonds are in place to reduce volatility and all that kind of stuff. But really, when we have good years and capital cities looks at the investment policy and recognizes they're at 70 or above 70% in equities, they shave off those winnings and they move that money over to bonds, earmarked for expenses. That's the machine. That's how the apparatus works. There are other plans that we represent that have equity exposures higher than this, 70, some at 72. Their returns for the year were a little bit higher than yours, but not that much higher. Bottom line is you've achieved your mission looking long-term. I think 10 years is long-term. And that's really what counts. You have a significant passive allocation here, meaning indexes. And you were really early in this fad. I mean, I should say fad, but the industry has moved very quickly towards passive in the last decade. And a lot of pension systems are even moving in that direction. Even FRS as passive exposure. So for the quarter, modest loss, really because of September was kind of a soft month. That was quickly made back in October, as Dwayne pointed out. Interestingly enough, the best performer for the quarter was high yield bonds at 0.9%, followed by the REIT and the 500 index, which is the Vanguard Institutional. I'll skip down to the 5-year number, which is really important because that's what Patrick uses in his work. The program earned 5.9 million, averaging 10.6%. Dwayne did a great job in beating the model, which we developed, designed to achieve the assumed rate of return, 7.5 to 8. And you rank in the top 34th percentile. Now, this is an important statistic because with this program, it's simple, it's low cost compared to your peer group. But to rank in the top third nationally is quite impressive. We don't have a lot of fancy products in here. We don't have any private equity. We don't have hedge funds. We're not doing anything like that. It's very transparent, liquid. It's easy for the auditors to go through this and see what you're doing and to understand it. So I think the simplicity has worked in your favor. I've already revised your investment policy. So you said you do things on the fly earlier? Did you say that? You said something about you were going to give a speech or something on the fly?
Oh, yeah, that was a joke.
Well, this wasn't, Joe. I was serious about this. No, but I just did it for you, and I won't bore you with the details. I'll bring it to you in March. We'll have it all worked out in March, and I'll get Dwayne's input as well. On page 7, you can see where you were 10 years ago. The police plan was at 7.3 million. And during that period, last 10 years, there's been a net outflow of about 3.4 million. And that's defined as inflows being employee participation in the plan, the city's participation, the premium tax 185 money contribution. And then the outflows are obviously the expenses for retirees, and then net was 3.4 million outflow. The earnings just under 10 million, so your earnings were 2.5 times your outflow. So that looks healthy to me. And I'll pause there for a minute. I don't need to go through every detail unless you want me to address anything specifically. I'm comfortable with what you're doing and don't recommend any changes at this time other than clarification of the risk parameters. IPS.
Just a quick question, Burgess.
Yes, sir.
I think Dwayne talked about kind of that moving average, and you alluded to some of the work that Patrick would do with, could you just give a thumbnail on the smoothing and over the years, have the good years allowed us some flexibility for potentially impending bad years?
Okay. You want me to talk about why they smooth?
Right.
Let's first start there. Cities, unlike corporations, have tight budgets, limits on what they can do. And so the cities don't like surprises, especially if they don't have a lot of reserves. Where a big corporation like your major employer here in town, if they have a problem, they can easily write a check and fix it. So because of the swings in markets can have an immediate impact on the minimum required contribution to the city. What the actuary has done is created a 5-year averaging of both the good times and the bad times. So 1/5 is 20%. So if you have a down year, you're only going to capture 20% of that negativity. And if you have a big year and you're up 20% like you were this past year, you're only going to capture 20% of that positivity. So it was all designed to sort of delay and smooth out, but in the end, you get to the same place. Does that help you, sir?
It does.
Okay.
During the training, it came up, it's a great year. Why aren't you increasing the pension payouts and things of that nature? But just for what you described, there will be good years, bad years, and we try to stay steady. So, all right.
See one head nodding. We got some agreement in the back of the room.
I would like to see a 20-year smooth and have more appetite for equities, but that's not going to happen. I don't, since the long-term nature of the plan is so important, that's why I wish we could do things longer term, but the actuarial science is what it is.
So Mass has a question that he's about to ask.
I'd like to know what your opinion is on the experience study.
Well, I'm not an actuary.
I realize.
I can give you medical advice. No, I'm just kidding. I think an experience study is an attempt to, it's just like a sobriety test. You're really trying to figure out with all this new information, are we doing things correctly? Are we on the right path? Are you using the right assumptions?
But if you're going to recommend that the assumptions stay at 7.5,
Well, that's just one assumption.
okay.
I'm glad you raised this question. There are assumptions about payroll increases. There's assumptions about turnover in the department. There's assumptions about mortality. Actually, that one's non-negotiable. And so those are the big ones. And then, of course, the return assumption is a big one. What did he quote the price as?
7,500.
How much?
7,500.
7,500. Well, and he recommended every 5 years. So a little over $1,000 a year if you amortize it out. So you're really spending a little over $1,000 a year,
1,500.
basically remeasuring what you've done or what you anticipate you're going to be doing. So I guess, for example, if your salary increases have been much greater than were anticipated, that salary increases expand the liability and create they really discount the funding status. It basically increases the liability. On the other hand, if the salary increase assumptions have actually experienced have been lower than was budgeted the last time he did it, that actually means that the plan is healthier, stronger, has a higher funding status than was budgeted. Is it worth 17 or $1,250 a year, whatever the number is? I don't know. The plan is, at 14 million. Before you know it, you'll be 18, 19 million. These are every dollar is important, and I understand the reason why you're asking about the expense isn't necessary. I would say this, that with the 85 clients that we report to as a firm, or 4 of us who share these, the request or the recommendation to do experience studies is pretty much everywhere. It's not just, you're not being singled out. I would say it's happening across the board. Big plans and little plans. $350 million plans and $20 million plans.
Technique, 11, 12 years now. Is that on?
I think smoothing has been integral part of this program for a long time, decades.
But I know we changed it, whatever, I thought we changed it back in 2012.
You may have changed it from a different
The term.
period. You may have gone from 3 to 4 or 4 to 5, but yeah, I think that's what it was. But for cities, smoothing has always been utilized. I have one client that doesn't do it, the city of Sanibel. It's a very wealthy town. They have so much money in reserves, they don't really care. But everybody else we work for, they have a need to sort of cushion the volatility for obvious reasons.
Now, to my real question. I know you recommended back, I think it was in 2000.
Reads,
And looks like we've done.
you have.
Looks like we're cautious. Very careful with how much we allocate. That seems like we've been successful over the years. I've stepped away for quite some time now.
Not that long.
You're part of the reason why we got into reads, because you supported it.
Yeah, but I guess we were very cautious at the time. And now that the reset, it seems like it's not so real. Got a track, we didn't have a track record when we got into it. Now that we have a track record, whatnot, do we still think that?
Page 12, everybody, if you want to see where he's talking about, page 12.
You still think that we want to be, I guess, as conservative as we have been with allocating, have an allocation for REITs?
Well, we have a 5% target. And I have already, I've got a range of 3 to 8%, and that what I'll present in May 15th. The REIT is the most volatile equity in the program. It's a, as Dwayne knows, very volatile. But we've been around a long time. We know, I think we can handle this thing because of our experience. The REITs are doing extremely well right now because of the high replacement cost for commercial property, the demand for apartments, the recovery in the retail area, and the explosive growth of industrial, labor shortages, and high cost of property. All the replacement costs are driving this thing up through the roof. And I think the REITs will continue to do well going into next year. Year to date, since January 1, the REITs are up about 29%. Now there've been periods when they're down 35%. The first quarter of 2020, when everybody was watching TV too much and nervous about what was happening, the REITs went down 35%
I
in
heard
about
Dwayne.
6 weeks.
I heard Dwayne thinking back there.
I've seen a lot of pension funds. I never seen more than 10%. Because of the volatility. But they are a good surrogate to bonds because real estate can raise their rents during inflation, whereas bonds is a fixed income investment, doesn't move with inflation. So that's why investors drift a little into real estate more often.
Why don't you make the statement back when we did get it reset? It was help protect the portfolio.
It's an inflation hedge. It's really one of the, we're now seeing real time what I meant by inflation hedge, because we have inflation. It's crushing the construction industry. And that's why you're getting these kinds of returns out of REITs. Okay, I like them. They can be tricky. But look on page 12, the 10-year average, and the REITs has been 11.8%. And pretty darn good.
For instance, in the week, you have warehouses, like Amazon warehouses, you have hospitals, public self-storage, and apartments. That's driving, it, not the hotels and the restaurants. It's those that I just mentioned. A lot of warehouses and apartments, hospitals, healthcare, assisted living centers. That's what's doing.
And I guess my question is, and I know it's always happening, has been, but is our allocation still adequate for the that's how we'll move them?
Well, I'd say this, you're running roughly a 5% allocation. Good question. And when we report the 12/31 results, you're going to see about a 1.5% of your total return for the year coming just from that little 5%er. So the fact that it can have that kind of an up year with just 5% allocation and deliver 1.5% to the return means you don't want to go, as Dwayne said, you don't want to be at 10% in that thing because it can go down pretty fast too. The range that we're proposing for cap cities is 3 to 8%. And I think that gives them plenty of latitude and gives you enough exposure where it moves the needle.
Yes, you're saying yes, you're right.
I think so, yeah. Sorry about the long answer. You know, I dodge answers too much. You know, I just should say, yes, sir.
Any other
Anything
questions?
else? These are good questions.
Colonel, anything else? Anything else? Yes, okay. Nothing else?
That's it.
You've heard the report. Motion on the floor, is there a second?
Second.
Second by Captain Newcomb. All in favor, say aye. Opposed, motion carries unanimously. Thank you. Next up, Posner.
Hi, good afternoon, everybody. Can you all hear me okay?
We hear you.
Great. So no news is good news on my end. So I do not have any formal report to share with you all.
All right.
Unless there are any questions.
About the experience study. What's your take on whether we should commit to the experience study right now?
So I heard your discussion and I will, second what Burgess said that I am seeing this across a lot of the boards. You're certainly not being singled out, as he said. I never think it's a bad idea, to see how you're doing, to see, what changes should be made, if any. Of course, I am not an actuary, but I don't think you will regret doing it or spending the money, to have more information. And the more information you have, the more informed decision making you can have going forward.
All right. Thank you, council.
Thank you.
Board meeting scheduled 2022.
These are the dates that have been recommended, and they seem to meet our needs. The Fire Pension Board has agreed to them.
Any concern with those dates that are presented from the board? If not, I entertain a motion to accept. Not all at once.
Make a motion to accept the proposed Palatka Public Pension Board.
There's a motion on the floor to adopt the calendar for 2022 as presented. Is there a second?
Second.
Second by Mast. All in favor, say aye. Opposed, motion carries unanimously. Thank you. Expenditures.
So these are the fiscal year expenditures for the pension. You can, to the right, you can see the investment summary by company, and compared to the budget, the admin ex summaries. And the approximate at the last, under the right-hand side, the last figure, 68,000, is approximately what the city left in when employees were refunded their contributions. That is part of the actuarial study as well. He'll be comparing what these estimates are versus what he estimated. It is based on a percentage of what the pension is at a point in time. So if the pension goes up higher, yes.
Let's keep it high. All right, you've seen the expenditures as presented. Is there a motion to approve?
Second.
Motion on the floor to second. Any further discussion? Seeing none, all in favor say aye. Opposed, motion carries unanimously. Next up, we're open the floor for public comment. Is there anyone here for public comment? Please show yourself. Seeing no one here for public comment, we'll close public comment at this time. We're glad you didn't have any comments, Ms. Shank. Next up is other business. Is there any other business before the board at this time? Motion on the floor to adjourn. Consent, we're adjourned. Thank you. Merry Christmas, everybody.